Hello, welcome to episode 4 of the Iron Key podcast. We have our guest Rafe first here to tell us all about venture capital and the idiosyncrasies between game theory, poker, and really all the tangential markets to VC, such as crowdfunding. And we'll go through, Rafe's background and all the different components that led him to write his new book on the future of venture capital. And thanks for joining the podcast, Rafe.
Joseph, it's a real pleasure. I'm excited to get stuff of mutual interest.
Definitely. So why don't you kick it off? Tell us all about your background as a founder and really what drove you to this new journey on really trying to dissect some of the problems in venture capital. And we'll start there.
Sounds good. Yeah. So I was fortunate to attend Stanford University in the late 80s, early 90s, just before the web browser was unleashed and kicked off the Web 1.0 revolution. I studied artificial intelligence, and after a couple of years postgraduate school of doing research in AI, I decided with a few friends to start a company to really just take advantage of the new technology and opportunities. My first time in, as an entrepreneur, certainly as a tech entrepreneur, and we launched a company called Pick'em Sports. And these were friends of mine from playing games, in particular playing poker and games of chance and games of skill, probabilistic games. And we were all enthusiasts of office pools and fantasy sports, which at the time wasn't online. People were doing it with pencil and paper and spreadsheets. So our idea was to create a technology layer that allowed brands and companies like Yahoo to create their own white labeled fantasy daily fantasy sports, office pools, March Madness, trivia quizzes, etc. And we hit the timing really, really well. I had no idea at the time how lucky we got on the timing of everything, but we were able to build that out and sell the company. And we sold it in 99 after about 2 years of building it ourselves. We bootstrapped because venture capital wasn't as mature as it is now. And we'd heard horror stories. They were saying things like vulture capitalists, be careful of taking money from VCs. Some of those concerns are still really valid, but at the time, we just decided we're going to bootstrap this, use our sweat equity. By the way, I recommend that for anybody, for any reason, if you can bootstrap it. We can talk about the reasons why later. But we did that, and we sold it in a roll-up to a public company. So that was in 99. About a year later was when the web bubble burst in 2000, early 2000. By the end of 2000, we, like so many other people, were out of business. But the good news for me and my co-founders is that we had insisted in the buyout that not only would we get stock in the acquiring company, but we would get cash as well to make us feel whole and like it was a good investment if the gamble to get bigger didn't pay off. By the end of 2000, like I said, we were out of business. I was burnt out. I was wanting to go travel. I was wanting to go follow the professional poker tour because I've been a lifelong poker player, amateur poker player, and wanted to test my mettle. I didn't know it at the time, but that was a 3-year travel odyssey where I followed the poker tour, went traveling internationally. And then in the final year, 2003, 2004, I jumped in an RV with my best friend, going to every sporting event we could get to in the course of an entire year. End of 2003, beginning of 2004, I was done traveling. I was becoming broke and needed to figure out what to do. So I landed back in Los Angeles where I grew up. So my friend, Phil Gordon, who is the guy who we went on the Ultimate Sports Adventure with, was also an early technology guy who cashed out of Web 1.0, also part of my poker crew. He said on our travels, he said, I have this idea for creating a new kind of instructional video format where we put the expert in a movie, plying their trade, and we get the viewer inside the mind of the expert. And so was born our next company is called Expert Insight. And we did 5 instructional DVDs. First one starring him as a professional poker player. The second one with our friend Andy Block from the MIT Blackjack team, showing the world how to beat blackjack, how they did team play. And then we moved on to golf, and we got pros Jim Furyk and Fred Funk to break down the short game strategy. So our formula here, and we did 2 other DVDs, if there's something where strategic insights and strategic decision-making were key to the game and key to winning in the game or activity, we could break that down with this new video format. And, just as a way to, get inside my mind, I think about entrepreneurship, venture investing, or investing in general, and poker is really, and other parts of life is really very similar in the following way. They're all games of making really good strategic decisions over time under inherent conditions of uncertainty and risk, where there's something meaningful at stake. And so that kind of like was the unifying principle there. And during that time frame, as we're trying to make that Expert Insight successful, it was award-winning. People loved the product, but we just had horrible timing. It was bad strategy on our part. Google Video and YouTube were making content free. We were trying to sell into the retail market on DVDs. We just couldn't survive. And so we closed up shop after going through millions of dollars of our own and our friends and family's money. We still didn't take capital from VCs, but it didn't feel good to lose that one and to lose money for our friends and family there. During that time as well, I was really active on the poker tour, and I happened to win a World Series of Poker bracelet in 2006. I actually credit working on the DVD for Expert Insight as a training ground for really honing my skills in there. That's startup number 2. There was 3 more startups after that. Full Tilt Poker was one of them, and that became a unicorn investment for me. And I joined the team and was active kind of in the early going, especially in Full Tilt Poker. And then after that actually came crashing down after what's known as Black Friday. The US government decided to chase out all of the online poker that was happening in the United States. Pretty big blow for me financially and otherwise. We can go into that if you want. But after that, in 2012, started a company along with Chance Barnett called crowdfunder.com and a few other co-founders. And I was always fascinated with this idea of crowdfunding applied to investing in startups and getting equity. So not just rewards crowdfunding like Kickstarter or donation crowdfunding like GoFundMe, but I was really, really excited. And in 2012, early 2012, when we started, the laws had just changed nationally to allow for equity crowdfunding, whereas before that, it was really hard. It was kind of illegal to do equity crowdfunding, violate some securities laws. But the Jobs Act changed that and launched this market, or at least so we thought. We thought it was going to be a really, really big market. Still believe that it can be. We can go into reasons why that didn't work out and what to do to fix that. But I was with Crowdfunder for 4 years, 2012 to 2016. We couldn't really make it a financial go. That closed. But during that time, I had this idea for creating a new kind of venture fund within Crowdfunder called the VC Index Fund, where we indexed behind top early stage venture capital firms. And rather than doing the 25 to 30 deals per fund, we 10x that. The idea was to do 300 plus deals per fund. And the whole motivation there is I learned from some friends from my poker group who had started a different kind of venture, like a Moneyball venture fund called Right Side Capital. I was an early investor in Right Side. Right Side launched around the time that 500 Startups and Y Combinator and Techstars were showing the world that venture at scale, especially early stage venture at scale, was the game theory optimal way to do it. They're beating VCs in terms of a risk-adjusted basis, and also a non-risk adjusted basis, just inherent IRR, because they were going really super early, right? So I was doing pre-venture capital. So basically professionalizing and doing a quantitative approach to angel investing. And so when I got to Crowdfunder, I saw an opportunity to take all these really great deals on the Crowdfunder platform and do those at scale and bring in the VCs. So the best of both worlds. So that's Crowdfunder, and then I'll end it with after Crowdfunder was clear it wasn't going to be a success, and we had to close the doors. I'd been an early investor and proponent in Bitcoin. This is now like early 2017, and so I got together with some other early adopters, friends of mine, investors in Crowdfunder and early stage folks, and we started a new kind of firm oriented towards basically rolling up crypto assets at the time, initial coin offerings, ICOs at the time, and then even technology companies in and around the blockchain space at the time. And our model was Berkshire Hathaway. I'm not sure if you know, do you know the idea of Berkshire Hathaway, Warren Buffett's company?
Please
Yeah.
tell us. Give us the high level breakdown
Yeah.
of what that is.
Yeah. And so there are two kinds of public investment vehicles, roughly speaking. There's investment companies like, index funds and mutual funds, and there's operating companies. So, every other public company that you know of, tech company or otherwise, are operating companies. And so Berkshire Hathaway is an operating company that gives you diversified exposure to lots of subsidiary operating companies. It's a conglomerate model. And so with a single stock ticker, you could have a diversified exposure to entire asset class. Now, why this is important as a way of doing it is, remember back to 2017, there were no Bitcoin ETFs, no ETH ETFs, and there was no way for the average retail investor to get exposure to this burgeoning asset class of cryptos and blockchain technology, where Web3 wasn't even invented, back then. But this whole class of emerging opportunities and decentralized assets and DeFi, and so we had this idea that we could create a public company, and we did. And so we were going to create the Berkshire Hathaway for the crypto and blockchain space. We had an incredible run of it up until November of 2017, which is when Bitcoin really burst onto the mainstream for the first time. It was on its way up to like from 5,000 to close to 20,000, if you remember. It's late November 2017. There was very little float for our stock because we had just kind of gone public via what's known as a reverse public merger. Because the demand, this is kind of ironic, because like Bitcoin, the demand increases, the increased awareness for something called the crypto company. That was the name of the company. Increasing demand because of public exposure and people wanting to get in on the on the next big thing. We had razor thin float, meaning very little public stock available for people to purchase. So ultimate scarcity in the supply. So the stock price went through the roof, and it went from $2 to $5 to $50 to $500 to $700. And the SEC decided to take a look and say, they halted us and did investigations for 2 years, found nothing, gave us a clean bill of health, and sent us on our way. But that really killed the momentum there. So that's kind of been my, in broad strokes, my startup journey.
That's a fascinating journey. Before we go into some of the details around crowdfunding and how that could be done better in the VC market, it sounds like you've been through a roller coaster of a career. You've made and lost fortunes. I can say the same for myself. Maybe I'm a little bit younger though, but I would love to kind of just dissect your headspace and kind of going through those highs and lows and kind of how you've been able to develop like the fortitude to go from a failure to success to failure, and kind of like the almost like the emotional whirlwind that creates. And I'd be curious to kind of get your thoughts on like how you did approach it and how you would approach it in hindsight, and kind of like the inner workings of the battle of Rafe versus himself.
Yeah, for sure. No, thanks for the question. It's really perceptive one. And so I would say at the highest level, for better and for worse, all my experience in poker allowed me to really look at it from risk-taking, strategic risk-taking from an analytical, non-emotional perspective. And so on the upside, on the positives, it allowed me to be able to think and make decisions clearly and strategically without getting waylaid by the fears and the doubts. When, having big setbacks in poker, you're failing all the time. You're losing big pots all the time. Hopefully you're also winning big pots. And at the end of the day, if you get to the statistical long run after many thousands of individual decisions, the results take care of themselves. So you're going to have lots of losers and you have some big winners, and net, hopefully you come out ahead. And so that's been my approach and philosophy to both poker and startups as a founder and startups as an investor. And I believe that at a fundamental level, that's a good approach. That's one of the ways to win and be able to keep going in the face of a really big setback. On the other hand, there's a fine line between being not attached to outcomes and being detached or dissociative and losing one's ability to connect to really what matters, including other people, including our own emotions. And I think that's really dangerous. And I experienced it. If I had to do it over, what I would say is one has to really lead from the heart and from our values and our integrity as individuals, and never lose sight of that. And then from there, layer on the strategy and the quantitative mindset and the rational framework for going about business. Not flip it, not lead it, and not flip it like I had it flipped. For me, it was, that sort of cold calculating mindset from the, was the end all be all. Don't get distracted by the emotion or the human or soft side of things. Now I think that it's the opposite. Does that kind of clarify it for you? Or
It does. It does. And I think part of what I'm gleaning from that is that, maybe there's a little bit more to life than business. And through entrepreneurship, which is a lonely road, it's possible to lose sight of what matters. And I think it's important to kind of, have that cold calculating mindset, but also not be consumed by it. And again, I think I'm just trying to paraphrase your words, but steer me in another direction.
yeah, no, I mean, you bring up just holistic quality of life and quality of experience. And I always aspired to have a balanced, a balanced life, but I have fallen prey to, ridiculous, monomaniacal hours and monofocus and losing sight, and not only losing sight, but just losing touch with things that give me joy and, relationships that matter, of course, more than the business. So absolutely. I think what you talk about is a fundamental struggle for anybody who goes down the entrepreneurial path. There's definitely like a drive and an achievement drive and a productivity drive that unites us all. It's this, I think, common struggle to not let that consume or lead us, rather to be led by our humanity and our relationships.
And definitely sound advice for the emerging entrepreneur as well. I'd like to just go pretty deep into the crowdfunding experience first before we move on to more of the VC model. Rafe, why don't you give us your take on the crowdfunding market as you saw it when you were building that company, and then how you've seen it evolve, and maybe where you see the market going, and at a high level what opportunities are still there in the present and future, and kind of give us your 2 cents on that market.
Like I said, I was really always fascinated and captivated by this idea that we could democratize both access to capital for early stage entrepreneurs of all sorts. Doesn't have to be, tech startups. Mom and pop businesses could use working capital and equity investment, and the returns there are really, really high on an annual basis and steady. So this idea of democratizing access to capital and not let it be in the hands of the banks or the gatekeepers or the VCs, that really, really drove me and fascinated me and motivated me. But on the flip side, as I got more and more into it, and as my own angel investing and venture investing journey matured, I saw there was kind of an equal problem on the investor side. I mean, I don't have to tell you that it's an old boys club, you know, old boys and girls club, if you will. But the point is that there are gatekeepers and there is a hierarchy of people in venture investing. And why can't average everyday Main Street investor who can go on to E-Trade, for instance, and buy stocks in public companies that, I don't know, very high risk, but modest returns, 8 to 10%. Why couldn't those same mom and pop investors have access to early stage, exciting venture capital where the returns are more in the 20 to 30% annualized consistently over time? So I was an evangelist and a believer, and I am still a believer that, especially now with fintech tools like crowdfunding, but also very importantly, and this is, I think, where we go to fix it, DeFi, Web3, right? With these technologies, we no longer really need much or most of the infrastructure, the TradFi infrastructure that's in place today. There's some of it's really important, and there's concepts like, how do you, trust, but and whatnot, and vetted networks and diligence. I believe that the future is going to look so much different. I think so much of the financial infrastructure is going to be totally revolutionized in the next 15, 20 years. It's going to look very, very different than it is today, and the institutions are going to look very, very different. Okay, so what happened and where are we in the crowdfunding or equity crowdfunding space? All that being said, legacy institutions and powerful moneyed players aren't going to allow their industry to be disrupted or their world to be disrupted lightly. And so, in my view, the Jobs Act was a clear mandate from the U.S. Congress to really change and loosen the restrictive laws for for early stage for investing in early stage companies. And the SEC, which was tasked with writing the regulations based on the laws, they intentionally, in my opinion, stalled and neutered the most powerful and liberating features of the Jobs Act and Crowdfunding Act within the Jobs Act laws. And that's where we sit today. So there was many companies like Crowdfunder who jumped into the breach. Very few of them have survived and created a viable business model because of the restrictions that the SEC has placed on equity crowdfunding. They do so in the name, which is, it's a noble thing in some respects, in the name of investor protection. They're trying to, protect against fraud and scammers and whatnot. We're seeing this whole thing played out in the crypto world several years later. But at the same time, I feel like there are a lot of incumbent interests that are using that as a screen for the real issue, is they don't want competition. I mean, what banks want competition? What brokerage houses want competition from a crowdfunding site? They don't. It would be the end of their business. That's my opinion of like how equity crowdfunding got what I call stillborn. But I think I really believe that, that Web3 is the answer. I mean, and Web3 will revive crowdfunding and subsume crowdfunding within the Web3 ecosystem. I mean, initial coin offerings were crowdfunding, right?
Yep. Exactly. And it doesn't seem like we've seen any substantial implementation of crowdfunding in Web3 that gives us any sort of indication that, it's going to be able to compete against the larger players, right? So my next question is, we haven't seen any really innovation in crowdfunding in 5, 10 years. And besides the regulation, do you see that changing anytime soon, or where do you think the source of innovation in crowdfunding, even inside the Web3 space?
That's a really good question. I'd be curious, do you have any thoughts on that? Because there's a lot, maybe a lot of different factors, and I'm not sure that I have a real good answer or handle to that, and maybe we can just talk about it.
Yeah, so let's talk about this. So when you go onto a crowdfunding site today, how, as an investor, do you know what is a good deal or not? There's no, there's no real way to play, let's just say, play wisdom of the crowd. As an example, in the public markets, there are traders that trade off of what larger players, hedge funds are doing. Now, drawing that corollary to crowdfunding, shouldn't there be a better way for investors to make decisions rather than just viewing a seemingly random collection of startups that maybe they happen to be able to afford a 10 or 15 grand listing fee on a crowdfunding site? So from the investment perspective, like, what do you think can be improved there?
Yeah, okay. Yeah, that's a good place to start. So the way I look at it is, any investment, right? What's the fundamental value, right? What's the fundamental value proposition? And when you're talking about public stocks, right? These are mature companies and they have a real business with revenues and profits. And presumably the fundamental value proposition is that they're going to make more money in the future. They are going to grow. If you're investing in an individual company, they're going to you're investing in the prospect that they're going to grow quicker than their competitors or the market as a whole. That's why you choose one stock over another. In order to justify that, you would have to look at, okay, the fundamentals of their business, what their defensible technology is, and a host of other fundamental value factors. That, to me, that's the primary thing. And then when you have something that's publicly tradable, you also have to look at, market dynamics, like, what you think is going to be, what the crowd is going to be excited by in terms of driving up the price of the stock. And so when you're talking about startups, there is currently no secondary market. There's no liquidity for them. You're investing presumably in the value of the activity of the company. And I guess the when you're talking about startups, it starts with an idea, right? Or a technology that's being developed into a possible market opportunity. That's what most people key on. But, those of us who've been in entrepreneurship and who have invested in entrepreneurs know that none of those things, the idea, technology, market opportunity, those don't get executed or created value, become valuable by themselves. They require the founders or the founding team. And so my view is that you're basically 100% investing in the founder or founding team. And that's the only thing that really you should be investing in. Yeah, they're going to come with an idea, but you know as well as I do that some of the most successful early stage investments pivoted 2 or 3 times before they actually became successes. So that's all the founders. So, I mean, we could go into how do you choose founders, but my opinion, the thing that would really move the needle on crowdfunding and investing in early stage venture is have the ability to really be able to understand who you're investing in and get really comfortable with, hey, I'm betting on this person or this small founding team to figure out a way to make my investment valuable. That's on the one hand. And then also the ability to actually do that at scale broadly. Because another thing that's like this is one of the myths of venture capital that, as I call it, which is the data shows that nobody really has a better crystal ball at the early stages than anybody else in terms of picking winners from losers, picking unicorns from, companies that go out of business, than anybody else. Not the top tier VCs, not angel investors, nobody does. So it's a numbers game, right? There's just so much inherent uncertainty at these earliest stages that it takes, not only incredible founders of great character and grit and, and brilliant, but it also takes a massive amount of luck. And so in that situation, and again, I come back to poker, that describes the poker situation. If you're going to win poker, you have to have all those things, including the luck. Um, so if you can really spread your bets, broadly and take down the ticket size to a very reasonable amount, I believe that the answer is, maybe 100 early stage deals per year for at least 3 to 5 years to have a diversified portfolio that's resilient. And then that will, from the investor side, really allow you to harvest what's called the risk premium at early stage without the risk of ruin, the risk that you're going to lose all your money or fail to return the target IRR.
Yeah, that makes a lot of sense. What I resonate with mostly is that I think you're better off investing in great founders with a good idea rather than good founders with a great idea. So it just becomes team is greater than idea, 98% of the time. And I think that's the way I would summarize it.
Yeah, I mean, I'd say yes. I think you did it very succinctly. I agree with that 100%. I would simply add invest in great founders at scale, meaning, the average VC fund, I believe, is under-diversified by a factor of 10, a full order of magnitude. I mean, that has some follow-on, knock-on effects for everything downstream of that. Perhaps maybe the number one thing or way that the venture capital ecosystem is broken is there's not a way for enough capital to get to a broad enough base of early stage opportunities to move the needle.
Yeah, so it's almost like there's a bottleneck
Bottleneck.
that's choking the capital flow to these early stage ventures, and then even the venture firms that do well grow big enough to where they can't deploy at the earliest stage. They almost price themselves out.
Yeah, they don't need to. They could do a different model, but it's very lucrative because they're getting 2 and 20, getting 2% management fee, which is risk free, right? So that incentivizes them to create larger and larger funds, right? That's risk free, 2%. So $100 million fund, that's, over the course of 10 years, that's 2 million a year. That's 20 million in risk free management fees. And then another 20% in carry, right? And so they get a free shot, and they don't lose even when their LPs, their limited partner investors, lose. And here's a dirty little secret: over half of all venture funds lose money. They fail to return 1x capital, the initial capital, to their LP investors. That's over half. And it's so it to me it seems really abhorrent that yeah, that could be the case where, a venture firm can get, $20 million management fees and not return 1x capital to their investors.
Absolutely. And you mentioned the 2 and 20 model, so I'd like to dive in a little deeper. The
Mhm.
2 and 20 model, like you mentioned, it works great for the larger fund managers. 2% of a large amount of capital is a lot of money. right? However, as a small VC fund, 2% management fees doesn't really cut it anymore. And that's really a main driver of why we built IronKey. And taking it a step further is that the Fish Network is designed to reinvent the 2 and 20 model by giving more upside, but more than upside, mostly diversification to these early stage startups. So really trying to stress test this 2 and 20 model and find a way to level the playing field in early stage investing. So are there any
Yeah.
are
You
there
want to
any
say more about that? You want to say more about like what the change is? If you don't want to talk about it, that's fine, but I'm very curious.
Yeah, I do, but I don't think on the podcast.
Okay.
I kind of bite my own tongue there a little bit, but I would love to talk about that.
Me.
Um, and I think that will come in the next episode. I don't want to
Yeah,
give up my good secrets yet.
there you go.
To the market, at least. I don't mind sharing them with you. To the market.
Yeah.
I don't. So we touched about 2 and 20. Do you have anything to add there on a better model for 2 and 20?
Well, okay, so maybe we can tie it back to crowdfunding, right?
Yeah.
Why do we need VCs anyway? Why can't a startup founder go just list their what they got and what they're looking for on a crowdfunding site, and the people, the adults who are fully capable of making their own decisions, can do their own research, talk to the founders, decide how much they want to invest or not, and just do it on their credit card or whatever in crypto. Write a check. It doesn't like.
In an ideal world, I'd agree with you, but the SEC would say I would just say investor protection, right? And accredited versus non-accredited. But in an ideal world, that would be the best solution, and then founders wouldn't need to rely on VC capital as heavily as they do.
Yeah, exactly. And so like I think this accredited investor thing is bullshit. It's like you're telling me I'm an adult, I can't do what I want with my own money. And I get it. If you as a regulator feel like there's a ton of scammers out there, great. Yes, make it illegal to scam people and go after that. But why should you block my ability to make my own decisions with my own money? Like, I feel like, with the caveat that nobody is endorsing this except for the founder themselves. I'm relying on my own judgment about whether this is an investable company or whether the founder is sincere and they're on the up and up. I should be able to go. I mean, this is free market. Like this is a free market argument, and so I just think it's ridiculous.
I agree, and I think at some point the SEC will get around to changing those, but just tying it back to crowdfunding. Here's my thought: is that it's rather cumbersome and expensive for firms to comply with Reg CF, which maybe is part of the reason there's not as much crowdfunding going on. And it's so from my understanding about when you say 2% management fees, that doesn't work in the Reg CF space because it comes out to about 10% in fees going to complying with KYC laws under Reg CF and those types of things. And I'm curious if you have any thoughts or insight on that side of tying it back to crowdfunding when it comes to 2 and 20 and the fees required to really execute that, even as a founder as
Yeah.
well.
Here's the fundamental problem: is we're in a regulatory paradigm where you're not allowed to let people make their own decisions. Therefore, you have to vet them and you have to qualify them and you have to, you know, do all sorts of things that cost money and therefore require charging fees, whether it's a Reg CF platform fee of 10%, whether it's, you know, 2% in a fund. What you're paying for is the regulatory infrastructure. And what I'm saying is, yeah, that's the world we live in. And of course, we're all going to play by those rules. But can you imagine a new world where we scrape away that and we start with the fundamental premise that, you know, we're adults, we can play at our own risk and let the chips fall where they may. I mean, you're seeing this happening by default in meme coins and shit coins and scam coins. And, you know, it's not, and it's totally the Wild West. Yeah, it's true. And there's rug pulls and all these bad things that are happening. And at the same time, do you see like a mass of people like saying, you know, who have gotten into that world saying, boy, I just don't want to play it anymore because I've been scammed one too many times. I just don't see a mass exodus. I see more and more people wanting to get in on the new wave. And so, and when I say new wave, I'm not saying that dismissively. I'm saying that this is the future, right? This is where innovation is happening. And if you want to generate returns, and if you want to be ahead of the curve, you're going to have to invest in innovation, which means you're going to have to take risks. So if you take a diversified approach like I'm talking about, and you're not, you know, you're not worried about whether one or two things in your portfolio turn out to be scams, it's like, you know, it's just a blip in the road, but you have a quantitative, resilient approach. That's my belief of an alternate framework is let people do what they're going to do. Obviously, prosecute bad actors. We have laws that are already in place for that, but don't spend so much time gatekeeping on the front end and trying to protect everybody from everybody else. Let the free market work. Let people connect and invest in one another as they see fit.
Hopefully, slowly over time, we'll get to that sort of reality. And like you mentioned before, really I think maybe the one of the only hopes, or at least the only hope I see is, you know, is going towards a decentralization approach with Web3 to make that happen. I'd like to go a little deeper into the traditional VC model before we get to some maybe we can talk about some interesting experiment solutions in the Web3 space. But would love for you, Rafe, to just give us some more insight on the traditional VC model and why it's broken, and some of the, I think, just some of the myths that I know you cover 9 of them in the book. Maybe give us one or two that you feel like riffing on right now in terms of why the model's broken, and then we'll start to explore some solutions.
Totally. Yeah, happy to. So we've already talked about that there's this myth or false assumption that, you know, the best VCs and best angel investors can tell a future unicorn from the herd. That just isn't borne out by the data. We talked about the lack of diversification required. Yeah, here's one. So there's this idea, this myth that what drives venture returns and thus justifies the traditional venture capital model is the unicorn investments, the ones that return 100x or more to their early stage investors are the ones that actually make up for all the failures, right? There's this saying 9 out of 10 startups go broke, and then the one makes up for all the losses and then some and gives you a healthy return. Well, it turns out if you look at the data that's actually not quite true. It's not the unicorns. I mean, unicorns are great, and yes, they will absolutely move the needle on a particular fund if you happen to get one. There are very successful, you know, 3-4x multiple funds, which is, you know, call it 20 to 25% IRR funds which is the target for VC firms. There are very successful funds that don't have any unicorns, and they make their money from singles and doubles. They make their money from sub $100 million exits. And there's data showing that actually the best return on capital is not from the unicorns, cash on cash basis. It's from the sub $100 million exits, call them the singles and the doubles. The diversified approach that I call it Moneyball after the movie Moneyball, and it's just hitting singles and doubles is a better strategy than swinging for the fences all the time. It's just been proven in sports, and it's proven in venture capital too. So that's one. There's a related myth, since the VC model, traditional VC model, is predicated on identifying potential unicorns and then pumping all, the bulk of the VC's capital into the later rounds. As the risk goes down and it's clear who the winners are going to be, or so we think, pump more and more money. So the whole VC model is oriented towards this strategy. If you look at an alternative model, the one that I'm talking about, where you massively diversify, there's always going to be another early stage startup that you can get better expected returns from. This idea of expected value, expected returns. The earlier you go, the higher the expected value on average, independent of the startup. It's just this kind of risk adjusted basis that we're talking about. So in a universe where there's plenty of new investments at the early stage that you could do, if I had $1 and I'm thinking about, should I invest it in this company at stage, at stage C, at Series C, or should I go for another pre-seed? Dollar on dollar, it's a better smart money investment to invest in a new company, because you're just going to get lower returns. Now, obviously, your risk, so to speak, is a lot lower on that individual decision if you invest in the later stage of a company that you've already invested in. But if you're looking at it from a portfolio theory standpoint, from a full portfolio approach, you're better off investing in a new company. So, I say, do no follow-on investing. And I learned this from my friends and partners over at Brightside Capital, and that's their approach. Is they write the earliest check. It's one and done, and then they help their companies in other ways. But they're taking the earliest risk, and they're harvesting that risk premium.
I certainly agree with the the diversification and follow-on strategy. And when a company gets to a Series A, all of the returns for that per unit of risk are, in my opinion, essentially gone. You're at Series A, you're looking at a 50 or $100 million company valuation. It's just that's all of the upside is gone. And I truly resonate with the singles and doubles in VC. I think especially with the way AI is changing the game, it seems to be even more of the right approach. You mentioned earlier around vulture capital. So I'm curious if you could flush out some of those concerns for any founders listening in around, why, what are the concerns, and especially if, the founder does have a venture backable idea, big vision. What are some of the concerns around vulture capital, and what can be done to mitigate that?
Well, I'll caveat this, or preface this by saying that I don't think that the people, the venture capitalists, are vulture capitalists. I think they're, by and large, really great human beings. They do good work. I think that the system of venture capital as it stands is predatory. And I'll outline some of the reasons or ways in which I feel it's predatory. The first goes back to this idea that you're looking to find the next unicorn. And so this has consequences for how the funding gets deployed, and then what the terms are that go along with the funding. So it starts with the idea that the VC firm is going to need to have control hooks. They're going to need to have preferred return. right? So they get preferred return in the case of liquidation before the founders themselves and before common shareholders, advisors, and whatnot. So that's a structural inequity that misaligns the incentives of the founders to build a great company with their investors. If the investors can get out, risk-free or with a lower risk profile than everybody else left holding the bag on the downside, that's not good. To me, that's bad. Control provisions. Oftentimes, most of the time, the VCs want board seats, meaning that they want the ability to have veto power and say in the strategy, but most importantly, they want the ability to yank the founders, the founding CEO, and install a growth-oriented CEO. For those who aren't really aware, there's really kind of two major stages of entrepreneurship. There's the early stage, and then there's the growth stage. And most of the time, the founders who are really good at early stage are not good at growth, or hyper growth, I should say. Hyper growth being what the unicorn game is all about. And vice versa. There are people who are really good at blitz scaling, but they're not the people who are the best at, starting new things and getting it off the ground. And so there's this conundrum that a venture capitalist has of like, well, I'm betting on these early stage founders, but I know that most likely if they're going to get to that unicorn stage, we're going to have to replace the founder. Yeah, there are notable exceptions. Mark Zuckerberg, right? And Brian from Airbnb. There are founders who are good at the beginning and then they grow with the company. But I think there's a myth that it's good for the company and good for returns even for a VC to yank the founding CEO. It's their company after all. You're buying a minority position as a venture capitalist. So in my opinion, if you're not prepared to stick with the founder come hell or high water, you shouldn't be investing. And you shouldn't be investing with the idea that when it's expedient for you, you're going to yank the CEO and replace them. Similarly, if you're going to be doing follow-on investing, there's all sorts of drag along, tag along, right of first refusal, anti-dilution protection, things that just don't need to be a part of the equation if you're really a value-aligned investor with the founders and the other stakeholders. And there's one more thing there. Let's say you have a company, this happens all the time. It's on a fast track, it's going through Series B and it's on the fast track. We as VCs, we're priming this to be the next unicorn. We're going to be betting a lot on it. So now we have this war chest of most of our capital that we've raised from LP investors. We need to deploy it. Well, we're going to look for every opportunity to deploy it in something that, we see as on a hockey stick and we can really add rocket fuel to its growth. Well, that's not necessarily what every company needs. That's a one size fits all. It's a unicorn or bust, big exit or bust. And let's put it this way. There's incentive for VCs to take a big gamble with their LP money in getting those unicorn exits, because if they hit singles or doubles, it's not going to get them necessarily into the top quartile of venture funds, which they need that track record, so to speak, in order to raise their next round. So if they produce a two-bagger for their fund as opposed to a four-bagger or more for their fund, they're not going to raise their next round because there are VCs, whether they're getting lucky or they're somehow really much better than you, they're going to be putting up four-baggers, five-baggers, six-baggers, and that's where the LPs are going to orient. They're not going to invest in if you doubled their money, but you protected their downside. So there's this dynamic which is a follow-on of the VC model and what they need to do to raise money from their LP investors that has them basically doing factory farming. It's the equivalent of factory farming for unicorns. It's not healthy. It's not healthy for the companies in most cases. Every once in a while, yeah.
I agree. So, I think what I would say is that, VCs are at this point, still are a necessary evil. They will fund the innovation that a lot of the times, I think in today's market, or at least in the previous cycle, there would be no way for these big ideas to get to scale without venture funding. I think we're starting to see that change in a big way. But the model, the VC model, which is now over 20 years old, is just not really working for most people anymore.
Yeah.
And I think that's just kind of the, core driver of
Yeah.
Iron Key's investment strategy, you writing your book, right? It's kind of why we're here today. So I think, and I think on a long enough time horizon, I think, we'll start to see that change. And I think we need more people, thinking in that direction rather than just following the herd. And so I think we're here challenging the viewers to push this agenda forward a little bit.
Yeah, I'll just say one more thing to that. I think I like the way you said it. What if, getting to scale wasn't the end all be all? What if creating a cash flow positive, organically growing company to its natural limits, to its natural scale, were the goal? I think we'd see a different mindset, right?
You mentioned Y Combinator before, so I'll share. Iron Key is vying to be like a Y Combinator for Web3 built on top of the foundation of a cash flowing positive ecosystem. There's just been too much focus on growth at all costs and this whole game of unicorns, when really the singles and doubles are what will allow founders to align with their investors in a more healthy way.
Yeah.
And I think, that's just, I think, really the core reason why we decided to build Iron Key, again, to your point, as an operating company and not a fund directly, at least not at first.
Yeah. Yeah. Very good. I love it. We're very, very much singing from the same song sheet there.
Yeah, why don't we go into some of the solutions out there in the Web3 space, and maybe we can start with liquidity, because we know that blockchain has a good opportunity to introduce liquidity for all asset classes, right? Venture is no different. Let's just talk about this, maybe the state of liquidity in venture capital. And I'll kick it off just by talking about, there has been a rise of secondary markets in venture. Carta X actually shut down its secondary market because its employees were essentially insider trading off the cap table and soliciting other investors based on the cap table information that Carta had, which ultimately led them to shut down their secondaries business at Carta. But we've seen the rise of other secondary marketplaces for venture equity, like Forge is a good example, and we've also seen, even since the beginning of Web3 in 2017, we've seen these large security token marketplaces like T0, Securitize, and there's plenty more that are trying to enable, blockchain-based liquidity for venture equity. I'm curious around, what you've seen over your career when it comes to liquidity in venture, and if you have any insight on that market.
Yeah, no, I mean, you're informing me. I don't see a lot with respect to liquidity, and maybe we can talk about some of the reasons why, or some of the things that are blockers for that, but also what are some of the solutions that we see, respectively. I mean, I think one of the big problems that you really highlighted is if there is going to be a liquid secondary market, how do you get around this idea of insider information, insider trading, and unfairly advantaging, um, the buyer or the seller over the buyer, for instance? I don't think there's an easy solution to that, frankly, beyond doing away with this idea of insider information. If you come from a sort of a traditional markets world, you're talking about commodities businesses where there's lots of competitors for every single company, direct competitors. They're competing for the same customer base, and oftentimes their competitive advantage is just their proprietary strategy, right? What they're doing internally. You don't want that information, what moves they're going to make, they're planning on making, how they're deploying capital. And so it makes sense that you need to have protections and have that ecosystem of information stay inside the company. Talking about early stage innovation, where as soon as you create a plan, it's obsolete. Company needs to pivot and take a lean approach. I don't think that early stage innovation really requires insider information. And in fact, when you're dealing with projects and organizations where there are network effects involved, you don't want to guard your information about what you're doing. You want to share it to the world. This is the idea of a decentralized project, a DAO, for instance. There's no inside information in a DAO at all, is there?
There shouldn't be,
Right.
right? I
And
think you're hitting on
yet,
a really important point
yeah.
here.
So just to land that plane, and we can go wherever you want with it. For decentralized apps, decentralized markets, decentralized technology, decentralized organizations, there's no such thing as inside information. In fact, you want everybody to say what you're up to, shout it from the rooftops, because that actually drives adoption as well as demand for the tokens. And so it's kind of an inverse of what you see in the public markets. It's a very different universe, different dynamics. And within this universe, there's no insider information. So there wouldn't be a problem in that Carta situation. And I would go further and say, like, well, I don't know. I mean, there's probably a gray area when you're talking about traditional startups. There's trade, there's intellectual property, right? And so if you have people who know things about the intellectual property, you don't necessarily want them, laying off their equity in a secondary market. But I don't know. That's a whole other ball of wax, and maybe there's a hybrid approach in traditional corporate structures for early stage. But at least when we're talking about the new world, where things are ultimately heading, I think you and I are believers that the traditional corporate structure is not long for this world. Eventually, everything is going to be on rails. It's just a superior technology, in the same way that crypto is a superior technology than fiat money. In that new world, there's no insider information. There should be secondary liquidity for everything immediately. You might have lockup periods, just to stabilize the market, as you build out your, towards your launch. But let the chips fall where they may. Again, a project that needs a 3-year lockup for its decentralized token from early investors, to me, that doesn't make sense. Like, if you have something great, share it with the world and get everybody involved and have liquidity right from the get-go. Let the market speak.
Yeah, and I think part of what you're getting at with the corporate structure and DAOs and we've seen a lot of that innovation over the last couple of years. And my opinion is that the market wasn't ready for that yet. with AI now, some of this decentralized coordination becomes a lot more possible. But, for example, we've seen 95% of these community-driven investing organizations called venture DAOs. We've seen 95% of them fail because there's a coordination problem. And I joke sometimes and say that DAOs are a disorganized, autonomous organization. But I certainly believe that on a long enough time horizon, that does get solved. I'm actually not convinced that that is around the corner in decentralized. It seems to be still the outlier, not the norm. And I think that continues for some time. But yeah, before we go into venture DAOs, I just want to comment on something you said. So in the public markets, it's illegal to trade on insider information, right?
Right.
In the private markets, one way that I explain it, or I try to explain it, is that by being an early stage investor, an angel investor, a venture investor, you're paying for insider information. You're paying for access to innovation,
Yeah.
and the knowledge and learnings that come along with that. Founders have some of the best knowledge that's not public yet, right? It's private. And I think as an investor, you're paying for a front row seat to that innovation by being able to meet with that founder, whatever it is, every year, every quarter. Well, you're paying as an angel investor, a venture investor, you're paying for access to that, to some inside information, or potentially valuable inside information that founder has into that specific market that they're trying to build in. And that's the way I view it when it comes to, private markets, inside information. But the reality is that that's not illegal in the private markets.
Yeah.
So that's what you're paying for, is you're paying
Yeah.
for that insider information to access. So I'll pause there if you have any thoughts on that.
Yeah, no, I think it's a brilliant point, and you're helping me see there's maybe a distinction between allowing individuals in the private markets to trade in a liquid fashion in a marketplace versus I wasn't aware of the Carta X example that you gave. There's a difference there, which is they're a platform which they have a fiduciary obligation to keep information private. They're kind of like overseeing competitors, and they're getting information. So as the platform itself, maybe you shouldn't be able to be trading, right? Employees of a company shouldn't be able to be trading on their market platform, right? So maybe that's a way to kind of reconcile those two competing interests. But as you said, look, if there was a neutral, there used to be one called I don't know if it still exists, called Second Market or ProShare. There was one called ProShares, I think. I may have it wrong, but there were a couple of secondary liquidity markets back 10 or 15 years ago, where it's like a stock market, private accredited investors only at that point, but could put their private shares of early stage on a secondary market. Mostly it wasn't early stage, it was later stage. But I think those probably work just fine in terms of the, integrity. And I agree. When you bought in as an early investor, you got a front row seat to early stage, and you're paying for that inside information. Now that it's de-risked somewhat, and you can find somebody who wants to buy in at this lower risk but higher valuation, you should be able to. And there should be, I think, platforms, decentralized or not, that allow people to do that.
All right, Rafe, thanks for sharing your insight into the future of venture capital and crowdfunding, and would love for you to just tell the audience where they can find your book and where they can contact you if they want to learn more.
Yep, awesome. Best way to contact me and to find out what I'm up to, including the book, is my website. It's my name, rafefurst.com, RAFEFURST.com. And the book is available on Amazon as well.
All right, Rafe, thanks for joining us on the Iron Key podcast. Talk to you soon.
Thanks so much. Appreciate you.